Are we on the brink of another economic crisis?
Join industry leaders like Donald Trump, Ken McElroy, and Danielle DiMartino Booth as they dive into today's pivotal financial trends.
We've distilled their in-depth analyses into quick, insightful takeaways powered by AI technology.
So hang tight. First up, Trump's recent bombshell insights from Davos that you won't want to miss.
Today, we're diving into Donald Trump's recent address at the World Economic Forum in Davos, which has stirred quite a response.
Trump's unique blend of candidness and controversy makes his perspectives particularly engaging.
Donald Trump demands that interest rates be cut immediately, reflecting his economic strategy.
He also calls for OPEC to lower oil prices to boost the U.S. economy.
What does Trump's demand for interest rate cuts signify for the economy?
His viewpoint suggests he believes lower rates will spur economic growth, although the market reacted differently.
Interestingly, following Trump's demands, the 10-year Treasury yield actually increased.
This shows that the market is skeptical of such political demands affecting interest rates in any significant way.
Can Trump's approach to OPEC realistically lower oil prices?
That's debatable. While his calls may have sway in some circles, actual pricing strategies are much more complex.
With Trump's urging for rate cuts, could we see a different inflation outlook?
If rates stay elevated despite Trump's requests, inflation pressures could linger.
How might a global recession influence the U.S. economy?
There's a risk that as other economies contract, the U.S. might not continue to stand alone as an economic outlier.
It's crucial to keep an eye on how the Federal Reserve responds to Trump's call for rate cuts.
If these cuts do not materialize, expect implications for both inflation and economic growth.
Investors should be cautious about oil price movements in the wake of Trump's OPEC statements.
Supply adjustments from OPEC could lead to significant price fluctuations, impacting the broader economy.
Today, we're diving into insights from real estate expert Ken McElroy.
Ken has been a leading investor and educator in the real estate sector for decades.
He's not only authored several books, but also runs a successful property management company.
Ken's knowledge spans various real estate sectors, making him a valuable voice in today's market.
Ken offers a deep dive into the ongoing challenges in commercial real estate.
He discusses how current economic conditions influence lending and investment.
Ken highlights the extend and pretend strategy banks have been using in commercial real estate to avoid write-offs on loans.
This approach allows banks to keep borrowers in their properties despite declining values.
He notes that most commercial loans tend to be shorter term, typically 5 to 10 years.
This leads to challenges when properties are worth less than what is owed as these loans mature.
Ken emphasizes that the market could see a peak in loan maturities in 2025, leading to significant challenges.
The extend and pretend approach might not last, causing potential disruptions in real estate.
How does Ken McElroy explain the extend and pretend strategy?
Ken suggests that lenders prefer to extend loan terms, avoiding taking back properties when values drop.
What does he mean by banks not reevaluating asset values?
Ken indicates that banks often do not want to face the reality of losses, so they delay reappraising properties.
Ken highlights the importance of occupancy rates in determining whether an asset can be extended or not.
A low occupancy can push owners to walk away, leading to further complications.
What signs does Ken see for the future of commercial real estate?
Ken warns that we might see crises developing as loan maturities peak in 2025.
Is there a silver lining for investors in this challenging market?
Absolutely. Ken insists that distressed assets may offer great buying opportunities if approached correctly.
Ken advises investors to keep a close watch on which banks have high exposure to commercial assets.
This could indicate potential vulnerabilities in the market.
Investors should brace themselves for potential volatility as market dynamics shift.
Ken reminds us that understanding the timing of loan maturities is crucial.
Today, we're diving into an analysis by Danielle DiMartino Booth, CEO of the consulting firm Quill Intelligence.
Danielle is known for her insights on economic trends and labor market dynamics.
Danielle DiMartino Booth points out that while 255,000 jobs were added last month, the actual creation of jobs may not be as robust as it appears.
She notes substantial revisions in earlier job figures, which can mislead about the true state of employment.
What does Danielle expect for the unemployment rate in the coming year?
Danielle expresses that unemployment is likely to rise, especially with over 100,000 job cut announcements.
Could the inflated job numbers impact perceptions of the labor market?
Absolutely. As Danielle emphasizes, inaccurate imputed numbers can make strength appear stronger than it is.
What does Danielle foresee for fiscal policy changes ahead?
Danielle warns about a possible $4 trillion tax hike if Congress doesn't make meaningful changes.
How might upcoming policies influence market stability?
Danielle predicts more volatility in the markets as uncertainty around Trump's policies lingers.
What should investors do in light of Danielle's analysis?
Investors should watch for announcements from Congress regarding fiscal stimuli and tax policies, according to Danielle.
Danielle underscores the importance of identifying solid cash flow companies in today's market.
This strategy could provide a buffer amidst inevitable market fluctuations.
In today's discussion, we're reviewing insights from Jeff Snyder on the alarming trends in the UK labor market.
Jeff is known for his comprehensive analysis of global economic issues, particularly how they relate to labor and consumer behavior.
According to Jeff Snyder, the UK labor market has faced a severe downturn, with payrolls dropping by nearly 50,000 in December alone.
This follows a decline of 32,000 in November, indicating a critical trend.
Jeff highlights that consumer spending in the UK took a hit in December, with retail sales showing a surprise fall of 0.3%.
Such a decline raises significant concerns about economic growth and consumer confidence.
An important point Jeff mentions is that many governments are in denial about the ongoing economic realities.
He argues that the supposed recovery post-pandemic has largely been an illusion, now transforming into harsh realities like rising unemployment.
What does Jeff discuss regarding unemployment rates in the UK?
Jeff warns that the unemployment rate, which rose to 4.4%, is likely to climb even higher, indicating serious labor market issues.
Jeff also reflects on how labor market challenges are not isolated to the UK.
Indeed, he mentions that similar spikes in unemployment can be observed in various countries like Sweden and Canada.
Why is consumer confidence in the UK declining?
As per Jeff's insights, consumers are increasingly aware of job insecurities and reduced purchasing power, which breeds cautious spending.
What does Jeff predict about the future of the UK economy?
Jeff anticipates prolonged economic uncertainty, with businesses potentially laying off more workers if conditions don't improve.
What about labor market expectations?
Jeff affirms that unless there is a significant recovery, jobless rates are likely to continue increasing.
Jeff advises that stakeholders keep a close watch on unemployment metrics as they signal broader economic health.
This will be essential for understanding future job creation and economic recovery.
Jeff emphasizes the need to analyze consumer spending closely.
Changes in consumer behavior can often precede larger economic shifts.
Welcome to today's discussion, where we break down the recent analysis by Lynette Zang, founder and CEO of Zang Enterprises.
Lynette brings nearly 6 decades of experience in the financial sector, making her insights valuable.
Her expertise covers broad topics including debt markets and the implications of consumer debt.
Let's explore her crucial takeaways on the current financial health of consumers and the economy.
Lynette Zang pointed out that defaults on credit card loans surged to the highest level since 2010, indicating serious financial strain.
This surge in delinquencies reflects consumers struggling to keep pace with rising costs.
Lynette forecasts a huge humanitarian crisis already unfolding due to rising debt levels.
She stresses that many people are relying on credit to meet basic needs, leading to systemic issues.
What does Lynette attribute the increase in delinquencies to?
According to Lynette, when consumers' incomes don't keep pace with living costs, they turn to debt.
How has the banking system changed, according to Lynette?
Lynette explains that banks have shifted from traditional lending to risky trading, impacting their stability.
What are Lynette's thoughts on inflation and its future?
She predicts we face a hyperinflationary depression due to existing debt levels and rising consumer delinquencies.
What does Lynette foresee for consumers and the economy in 2025?
Lynette predicts that delinquencies will rise further alongside persistent inflation.
What changes could we anticipate in the banking sector?
According to Lynette, a significant financial crisis is imminent unless consumers regain financial footing.
What does Lynette recommend for individuals facing these challenges?
Lynette suggests that individuals should invest in physical assets like gold and silver to hedge against fiat currency risks.
Lynette emphasizes the need for community in navigating these tough times.
She believes collaboration and mutual support will be crucial for survival as economic conditions worsen.
Wow, what an enlightening panel we've had today.
Indeed. Lynette, Jeff, Danielle, Ken, and Donald all offered unique takes that really pieced together the financial puzzle.
Absolutely. It's clear they agree that real assets are a safe harbor in turbulent times.
Right? And yet there are such strong opinions on monetary policy. Jeff seems pretty skeptical of its effectiveness.
True, but didn't Danielle raise a strong point about the central bank needing to shift its focus?
She did. It's refreshing to hear a call for actual economic indicators.
And while we're on financial strategies, Ken's confidence in real estate as a safe investment is noteworthy.
Especially with Donald advocating for tax cuts to spark economic growth. A mix of strategies for sure.
If you felt the insights were valuable today, smash that like button and subscribe.
Yes, your support helps us keep bringing you to the forefront of financial analysis.
And trust me, you don't want to miss what we have lined up next. See you soon.